Yep. Black Girl Stocks official merch is now live, so you can either scroll down and click underneath this video, or you can go over to teesprings.com. We have t-shirts, different colors, different sizes, crew necks, sweatshirts, and I got the MACD tee specifically for my fellas. What's up, fellas? Go ahead, get the socks, make an outfit out of it. Get rich, stay rich, everything positive. You already know how we do. So go ahead, check out Black Girl Stocks official merch.
Foxtail from the D.
Hey, what's up YouTube? This is Foxtail Digital coming to you again with Black Girl Stocks. And in this video, we are going to be talking about how you can make money when stocks are going down. I believe that this is one of the best pieces of information that you can have with trading stocks. And for the most part, the main strategy that I've been talking about, especially if you guys are following our Sunday live chats every week, but the main strategy is looking for uptrending stocks, buying on a low dip and holding it for as long as it's gaining profit. Realistically, what's really going on in the stock market is when the stock is going up, somebody is losing, and when the stock is going down, somebody is winning, and vice versa. In this video, we're going to focus on 5 different ways that you can make money in a falling stock market. But first, if this is your first time watching this video, please make sure that you click that thumbs up button. It really helps bring more people to the channel. Also, make sure that you subscribe and click that notification bell so that you get notified anytime I upload a new video for you guys. Also, if you're new to options trading and you're stuck on what stocks to trade options on, how to find the best option picks, there's a service called Tiblio that offers amazing stock options screeners with credit spreads and long calls and put plays for you. So make sure to check them out, okay? They're constantly updating the list with new picks throughout the day. I'll leave a link in the description below. Make sure that you use my link when you do try it out. And if you don't like it for the first month, you get 100% money back guarantee return. All right, so that's just a little plug that I'm gonna throw in about Tiblio on there. I know you guys see this merch here, you know, got the merch. Yeah, it's the options for me. Bye, bye, bye. So the first thing that we need to talk about is knowing whether we're actually in a down or bear market, or is this just a stock market correction? The terms bear market and stock market correction are used together a lot of the time, but they actually refer to 2 different levels of negative performance. So a correction happens when stocks fall 10% or more from a recent high, and they can last anywhere from a few days to months or even longer than that. So on the surface level, it might look like a loss, but correction can actually be healthy. They really help the stock market by adjusting overvalued stock prices, and then they also open the door for more buying opportunities. So corrections are actually pretty good. Don't hate the correction. Just learn how to ride that thing, you know? So that's a correction. A correction can then be upgraded to a bear market once the loss reaches 20% or more. And because corrections are normal and happen very often, most people just ride them out and avoid getting whipsawed. Whipsawed. I literally just found out what that meant yesterday. Whipsawing is basically something that happens to probably all of us. When you get whipsawed, that's when you buy stocks just before they fall, or on the opposite, when you sell a stock right before it starts to go up. So if that has been happening to you, you have been getting whipsawed, baby. But when stocks drop to that bear market level of 20% or more, then we're headed into downtrend land, and smart investors have strategies in place to protect their investments, like stop losses and limit orders. You know, make sure that you always have a stop loss or some type of limit sell. It really makes your life easier for you. I promise you. We want to be proactive investors, and there's several ways that you can actually make money in down markets. The strategies are very simple. So the first way is by short selling stocks. If you hadn't heard this term before this year, I know that you've definitely heard about it now with all of the meme stocks, craziness going on, all this AMC, GameStop, etc., etc., etc. Okay, so short selling is a pretty easy process. Basically, you'll borrow stock shares from your stockbroker, whether it's Robinhood, Webull, E-Trade, whoever you guys are using, and then you're going to sell them immediately. The stock price drops, and then you're going to buy the stock shares back at a lower price and return those shares to the broker that you borrowed them from. And then you just keep the profits in between the sell and buy price. So let's just say, for example, you think that Tesla is overvalued right now at $675 per share, and it's gonna drop in price. All right, so I just want to use a little example. Okay, so let's just say, for example, that you think that Tesla is overvalued right now at $675 a share, and you think that it's gonna drop in price. I mean, look at this downtrend, child. Oh Lord. What is this over the last, even over a month, Tesla has kind of been in a little downtrend. So you might borrow 10 shares of Tesla from Webull worth $6,750 and then sell it for the current market price. Okay, I definitely don't see this happening, so I don't know why I'm using this as an example, but just go with it. So let's say that Tesla stocks drop to 500. So that would be kind of like around there. Okay, so let's just say that Tesla stock drops to 500 and now you buy the 10 shares back at this price for $5,000. So you see where we're going here? Then you're gonna return those shares that you borrowed earlier back to Webull, and we now have a net profit of $1,750. So that's just gonna be that 6,750 minus that 5,000, and that's how you get that. However, if the Tesla price actually rises to $700, then you would lose $750 with this trade. And that's basically going to be from that $6,750 subtracted from the $7,500. And obviously that's going to be a negative number. So I know you were in math, stop playing. So just with using this example, you can see how short selling can definitely be profitable in a down market, but there are huge risks associated with short selling stocks, if even for the simple fact that you can never know exactly how high a stock might go up. Let's just say you bought one Tesla share at $675. The most that you can lose is $675 because the stock can't drop to less than $0 in value, like unless it's just negative. With short selling, you could technically lose an infinite or an uncapped amount of money because a stock's price can keep going up forever, and if it's up, then it's stuck. No. I'm a barb, so I don't even know why I said that, but with that last example, if you had a short position in Tesla or you short sold it and the price actually rose to $2,000 before you jumped out of it, then you would actually end up losing $1,325 per share, and you bought 10. So you don't want to get into that road. You really don't want to get into that. I personally don't short sell stocks, but as you can see, it's definitely something to look more into if you know that stocks are dropping. To short sell stocks, you are going to have a margin account where your broker is going to lend you money to purchase stocks or any other type of financials. So keep in mind that with margin trading, because you are trading with borrowed funds, your profits are going to be higher and your losses are going to be lower due to the simple fact that you had such a low initial investment. You know, you're on borrowed money, so it's not really your money, but you're still making money with it. So that's the first way. I know that was a little short-winded, but keep an open mind and let's move on to the next one. And that is by either buying put options or selling call options. I'm pretty sure that you guys know the basics of what options are, so I'll spare you with the details. But if you are new to options and you need some basic info, I'll leave a link below to my options 101 video. An option is a contract between two parties, the buyer and the seller. So when when you're buying an option, you're considered the holder because you're holding on to it. You have the right to buy or sell whatever that stock is, 100 shares of it at the strike price, or you can just trade the contract profits and not buy or sell the 100 shares. And that can get expensive. But when you sell options outright, this is kind of similar to short selling. You do have the obligation, meaning you are going to have to buy or sell 100 shares of whatever stock that is for those option contracts if they do get fulfilled or assigned. That was a mouthful. So let's just say if the person that you sold the option contract to actually wants to buy those shares at the strike price, then you are going to be responsible to provide them with those shares. So I hope that makes sense to you guys. I hope that kind of clears that up a little bit. Buying a put option gives you the right to sell 100 shares of a stock at a strike price. And the most that you're going to lose is the premium that you paid to open the option contract. We already know that put options are going to gain value as the underlying stock decreases in price. So this can be very beneficial in a down market. So with options, remember that they do need to be exercised or closed within the time frame of expiration. So if you don't do this before the expiration date, that's when you're actually going to lose that premium amount that you paid. So let's say you're in a current trading position right now. You're in a stock market correction for a downtrending bear market. A put would definitely be something to use to make profit in this scenario. Next, you can outright sell naked call options. Now, I know in my options one-on-one video, I told you guys we don't ever want to sell naked options, and we don't. But if you're very confident in this and you feel like you have the information, knowledge, this is a for sure plan, then you can start looking into selling naked options. That's something that you can do. I definitely don't advise it for beginners, but if you feel comfortable with this option, go for it. When you sell a call option, you're giving the buyer the right to purchase a stock at a strike price by the expiration date. This means that no matter what direction the stock goes, if the buyer wants to exercise and buy those shares, you will have to sell the stock shares to them at that strike price. We know that call options gain value when the underlying stock increases, but in this scenario, we are selling a call option to somebody else. So when you sell an option, you will be receiving the premium that the buyer pays in hopes of the stock actually dropping. And to make profits when selling call options, the options must expire worthless. They have to expire out of the money. So if you guys have been watching the channel, you know that we briefly started talking about credit spreads, and this concept really reminds me of a credit spread, but it seems to be more risky doing the naked sales. I mean, that's something that you can look into. I'll have some more videos on that, but I mean, that's just another way. So I feel like we talked about two. Let's get into the third way that you can make money in a losing market, and that's by investing in what's called an inverse ETF. We haven't really talked about ETFs at all on this channel. All I can say is that ETFs are amazing. An ETF is an exchange traded fund, and they're basically a collection of stocks, bonds, futures, whatever, and they track movement in the stock market indexes. Stock market indexes are hypothetical portfolios of investment holdings that make up a portion of the stock market. And just one example of that, the top 3 most popular stock market indexes are Dow Jones, S&P 500 Index, and NASDAQ, just to name a few. So I know you guys have heard about those. ETFs can own hundreds and even thousands of stocks in different industries and sectors, or they can be solely focused on one market, like energy or consumer goods, food, anything like that. There's a type of ETF called the inverse ETF, and an inverse ETF is going to allow you to make money when the stock market or whatever index goes down, but you're not going to have to short sell anything. So an inverse ETF moves in the opposite direction of the underlying stock. So let's say, for example, SPDR S&P 500 moves up 1% today. The short S&P 500 ETF is probably going to drop by 1%. 5%. An inverse ETF creates this effect by taking positions in multiple securities so that the daily gain or loss is the inverse of the traditional index. So inverse ETFs use derivatives. I don't know if you guys took calculus or not. Basically, when you get into these inverse ETFs, you're betting that the stock market is going to decline. And if that does happen, then the inverse is going to rise in value about the same percentage that the market declined. Now, this is definitely not something that is a long-term play because inverse ETFs are updated based off of each trading day. So what might work today as far as ETF trading goes might not have the same effect tomorrow. If Dow Jones average ETF moves up 5% over a week or over a month, then the short Dow 30 ETF might not meet that same 5%. The main benefit of an inverse ETF is that it's gonna gain you access to quick and easy profits on a down day. Inverse ETFs are better used for quick flips. Maybe even, you can even say day trading. But inverse ETFs are definitely better than short selling because you're not having to have a margin account. But just remember, inverse ETFs that are held more than one day can lead to huge losses. And also, I just kind of wanted to show you something as far as the ETF goes. I'm just going to show you how to look at this on Webull because it's just, Webull makes it easier. The inverse ETFs, another name for it is called short. So you're going to have two main ETFs that you're going to see here in Webull. It's going to be short and long. The inverse ETFs that we were just talking about that are going to make profit in down days are the short ETFs. And the way that you can get to that is right here in Webull. Just click on markets. All right, and you see where it says hot ETFs, just click on view all. And it's gonna show you them by market, industry, commodity, things like that. And you could just click one. You can organize them by long and short. Long and short. The ones that we were talking about, the inverse ETFs, those are the short. So you're gonna want to press short on that. That one doesn't really have any. But yeah, so you want to focus on the shorts. And that's pretty much gonna be it. Like, I know this video is gonna seem short, probably not. Might seem kind of long, but it's really just a few different ways that you can actually profit in a down market. Would I suggest all of these ways for new upcomers? All of them, no. Some of them are a little bit easier. I think they're better to manage, less risky. But if you don't mind a little risk, I mean, like I always say, scare money don't make money, huh? But you do want to be sensible with your coins. We're not just throwing it away. We're not giving it away out here because when you're losing, somebody else is winning. Keep that in mind. But anyways, that's pretty much all I have for this video. I'm going to keep it cute, sweet, to the point. But like I said, if this is your first time watching this video, please make sure you click that thumbs up button. It really helps the channel. Also, make sure you subscribe, click that notification bell. Check out the merch below, you know what I'm saying? Very comfortable, very fashionable. Sit at home, make money in your nice stock attire. I don't know. But yeah, I'll catch you guys in the next video. All right.